Good morning, and you're watching Market Cafe on ET now with me, Vinny Motiwala. Along with me is Ankita Saxena as well. Ankita, very good morning to you as well. And I see the handover that is coming. Yes. It seems like a strong handover coming in from the US markets.
Yes, absolutely. Finally, Jerome Powell's speech was out yesterday, and though the market expected this, Federal Reserve Chair Jerome Powell confirmed yesterday that smaller interest rate increases are likely ahead, even as he sees progress in the fight against inflation as largely inadequate. Now, Powell said that he sees the central bank in position to reduce the size of the rate hikes as soon as December. Now, but he cautioned that the monetary policy is likely to stay restrictive for some time until real signs of progress emerge on inflation. Now, Wall Street applauded the remarks, and Dow Jones Industrial Average closed up 737 points or 2.1% higher to snap a 3-session losing streak. Now, tech stocks fared even better, with the Nasdaq Composite soaring 4.4% higher, and the S&P 500 added 3%. Now, on the back of this news, the 10-year Treasury yield dropped nearly 12 bips at 3.6% after trading above 3.8% earlier in the session. The rate-sensitive 2-year Treasury yield was also down 13 bips at 4.3%. Now, let's look at how the European markets fared. Now, there's another positive news that came out of the European markets. Now, Europe was the inflation data that came out yesterday. Now, inflation in the Eurozone slowed slightly in November, according to the preliminary figures, with prices coming off record highs. Now, inflation rose above the 10% mark last month, which is October, highlighting the severity of cost of living crisis. Whereas yesterday the data for November showed headline inflation at an annual 10%, representing a 0.6 percentage point fall from October. So now the inflation stands at 10% for November as opposed to 10.6%, which was the inflation number in October. Now, on the back of this, European markets closed higher. Pan-European Stock 600 closed up 0.6%. CSE was up 1%. FTSE and DAX closed up in the green but were largely flattish. So a good handover coming in from around the world all over. For more updates on it and in more details, over to you, Vinny.
Absolutely, strong handover coming in, but yes, important speech that was there by the Federal Reserve Chairman Jerome Powell, where he confirmed that the smaller interest rate increase are likely ahead, even as he assessed the progress in terms of the fight against inflation. Now, echoing the recent statements from other central banks officials and comments at the November Fed meeting, Powell said he sees the central bank in the position to reduce the size of the rate hikes as soon as next month. Let's listen in to what more he had to say in his speech.
So, when will inflation come down? I could answer this question by pointing to the inflation forecasts of private forecasters or of FOMC participants, which broadly show a significant decline over the next year. But forecasts have been predicting just such a decline for more than a year, while inflation has moved stubbornly sideways. The truth is that the path ahead for inflation remains highly uncertain. For now, let's put aside the forecasts and look instead to the macroeconomic conditions we think we need to see to bring inflation down to 2% over time. For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March. As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting and the summary of economic projections. I will return to policy at the end of my comments, but for now I'll simply say that we have more ground to cover. We're tightening the stance of policy in order to slow growth in aggregate demand. Slowing demand growth should allow supply to catch up with demand and restore the balance that will yield stable prices over time.
And that was Jerome Powell for you. And there's more economic data that's come out of US. The United States economy grew at an annual rate of 2.9% in the third quarter. the US Bureau of Economic Analysis reported on Wednesday. Now, this reading came in better than the initial estimate and the market expectation of 2.6%. The second estimate primarily reflected an upward revisions to the consumer spending and non-residential fixed investment that were partly offset by a downward revision to the private inventory investment. Now, imports, which are a subtraction in the calculation of GDP, decreased more than previously estimated.
And now Elon Musk thinks that a recession is coming and worries the Federal Reserve's attempts to bring down inflation could make it worse. In a tweet earlier, Tesla's CEO and Twitter owner called on the Fed to cut interest rates immediately. The remarks came in an exchange with the Tasmanian co-founder Vincent Yu, in which several others participate as well.
And Salesforce's stock plunged after it announced that co-CEO Bret Taylor is stepping down. CEO and Salesforce co-founder Mark Benioff will be the sole person in charge of the company. The company, however, reported earnings and revenue that beat analysts' expectations. It also says Salesforce stock fell over 6% in extended trading.
Some update coming in on Russia-Ukraine war front. Russian forces tried to advance in eastern Ukraine and trained tank, mortar and artillery fire on Kherson in the south, the Ukrainian military side said. Now, Western allies sought to aid Ukraine and its neighbors, and in Washington, a $1.2 billion contract for 6 National Advanced Surface-to-Air Missile Systems for Ukraine was awarded to Raytheon, the Pentagon said. Now, meanwhile, the U.S. Secretary of the State, Anthony, said that Russian President Vladimir Putin had focused his fire on Ukraine civilian population.
And the Biden administration broke its silence on European Union's deliberations over a $65 to $70 per barrel Russian oil price cap. He wanted lower prices, cited for some Russian Ural crude shipments should be approached with caution. European Union diplomats have struggled to reach consensus on a price cap level.
And the head of Meta Platforms Business Group said that the holiday shopping season started earlier than usual this year. Meta produced a Black Friday sale weekend that appeared to be the biggest on record. The holiday ad sales could be a welcome respite for Meta, which has been struggling this year as advertisers and consumers pull the big plug on spending.
And Jeffrey Epstein's estate has reached a 9-figure settlement with the US Virgin Islands to settle claims the disgraced late financier used the territory as a base for his decades-long sex trafficking operation. Dennis George, the territory's attorney general, said that the estate will pay $105 million in cash plus half the proceeds from the sale of Little St. James, a private island.
And the former Chinese president Jiang Zemin has passed away at the age of 69. The Chinese leader died of multiple organ failures after battling leukemia, according to the statements released by the Chinese Communist Party. He is widely regarded as the leader responsible for China's emergence as an economic powerhouse until his retirement in 2003.
And a court in Tokyo has ruled that a ban on same-sex marriage is in line with Japan's constitution. The same court, however, added that the absence of any legal system for same-sex couples to have families was an infringement on their human rights. Now, Japan's constitution defines a marriage as based on the mutual consent of both the sexes. The ruling came as 8 people challenged the ban and demanded around $7,000 in compensation each.
Okay. On that note, viewers, we are going to slip into a very short break. Don't go anywhere because we'll be back with more domestic data. How was the GDP data for India as well? We'll be back with that after this break. Welcome back, and you're watching Market Cafe on ET Now. Obviously, we did have the GDP data that did come in last evening, and India's economic growth pace slowed to 6.3% for July to September quarter. Now, the numbers are in line with estimates, but much lower than 8.4% in the same quarter last year. Also, the gross value added GVA figure came in at 5.6%, with manufacturing contracting by 4.3%. Our in-house economist Maithili Pusarnamat crunches the numbers for you. What does this actually mean? Let's go across and listen in.
Well, the GDP numbers that the National Statistical Office released this evening is a mixed bag. The overall number of growth for the second quarter of the current fiscal at 6.3% is bang on target what the RBI had estimated for the second quarter. So that is the first good news. But the not so good news is when you look at the internals, because apart from agriculture and services, which have done well, in fact, services have held on very well at 9.3%, and agriculture continues to show a stellar performance of 4.6%. But the disappointment really is in mining and more particularly in manufacturing, which actually contracted by 4.3%. Given that manufacturing is the sector where jobs are going to come and where you're going to shift people from out of agriculture into manufacturing, the continued poor performance of manufacturing is very disappointing. Just this evening, prior to the NSO release, we got core sector growth, which showed core sector growing at just 0.1% in October. So overall, the numbers, I would say the disaggregated numbers are very disappointing. And if you look at the gross value added, which really shows the level of economic activity in the country, that is even more disappointing because it is coming at only 5.6%. So though the overall growth is 6.3, the gross value added is only at 5.6, which really puts both the Reserve Bank of India and the government in a dilemma. Should they extend support? What kind of support? Should the RBI continue tightening continue to maintain its focus on inflation? Or should it pause, if not pause entirely, at least temper the pace of its rate increase? How should the government look at these numbers? Those are really the key questions that need to be asked. Government doesn't have much fiscal space, but to the extent that tax revenues have held up, it is certainly in a better position than it would have dared to think of at the beginning of this fiscal.
Okay, and let's just look at what the brokerage is also saying. We have a note coming in from Nomura, and they're highlighting on the GDP that the growth rate cycle has likely peaked. Now, a broad-based slowdown is underway is what Nomura is highlighting. Slow GDP growth, the key factors and spoilers are global spillovers that are coming in for the company, then fading pent-up demand, as well as the tighter financial conditions as some of the factors that are actually impacting the GDP of the country as well. Now, they expect a fall in growth from 6.8% in 2022 to 4.7% in 2023. Q2 GDP was in line with what they were expecting, and they envisage a 35 basis point hike at the December 7th meeting. Now, envisaging overall a 25 basis point final hike in the Feb meeting as well. So that's the update coming in from Nomura on GDP, as well as what are the expectations in terms of rate hikes coming in as well.
Right, so that was the brokerage on the GDP numbers. Now moving on, there's more trouble for cryptocurrency, especially with the CBDC debuting. Finance Minister Nirmala Sitharaman has once again called for the need to regulate the cryptocurrencies. Now, speaking to a news agency, Sitharaman says that India will raise the issue of regulation at the next G20 summit, which India will preside over. Now, she says that well-framed regulation are needed for cryptocurrencies across the world. Now, we may also see the crypto bill in the next parliament session, with the finance minister saying the government will decide on how to move forward on the bill.
Okay. And India's chief economic advisor, V.A. Nageshwaran, says that the financial condition in many of the developed countries are likely to worsen and which could lead to a risk aversion. He expects a global economic slowdown by FY24. Listen in.
Financial conditions in the developed world turn more unfavorable and risk aversion returns, whereas they have been on hold in September and October. And to that extent, it would have an implication in terms of strong dollar, and global risk aversion will also have implications for capital flows into emerging economies. If the global political environment does not deteriorate, and given the global economic slowdown that is anticipated in 2023, and we are seeing that in the recent decline in both West Texas crude and Brent crude prices. So if they maintain their current trend, then it will not be a headwind for India's growth.
Right, and moving on, it's an ET Now news break confirm. RBI will be starting with its digital currency pilot test for retail investors this week. Now, the central bank has confirmed that 8 banks will be involved in the pilot testing, which includes SBI, HDFC Bank, among the others. Now, what else does the RBI have in plan? Ankur Mishra was the one who had got you all those details earlier and filed this report with all the details. So let's take a look at what he had to say.
If I explain you in one picture, that means that digital rupee mean this wallet will be transferred to my phone. How will it happen? The banks which will be in partnership with Reserve Bank of India, they will provide these kind of wallets, and you will have token based system in the retail CBDC which has been identified. So you should think like a physical cash which is moving to your phone. Now how it will be different from UPI or any other digital transaction which you are doing currently? The only difference is right now you are keeping your money in your bank deposit, right? And for when you are using this CBDC, the only difference will be like you take out cash from your bank account. Similarly, you will be keeping that cash in your phone wallet. As far as the transactions are concerned, it will be seamless, it will be interoperable with all the current systems, but you will not be getting any interest on the same. Now you can ask why you are not getting interest. The only reason is that when you withdraw your cash from your bank account, you don't get any interest on the same. Similarly, in the CBDC as well, you are not going to get any interest on your cash withdrawals. So similar procedure is applied there. As far as the usage is concerned, the only problem which currently physical cash has, suppose you have 100, 200 kind of bank notes, and when you need to give it to someone, those change are not there, and that is why UPI it took off. Here, the convenience is that, by using CBDC, that kind of problem will not be there.
Thank you so much for that, Ankur. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll be back with more stock updates after this break. Welcome back, and you're watching Market Cafe on ET. Now, let's get in an update of how the Asian markets have opened up as well. Seems like opened up on a strong footing coming in this morning, whether you see the Kospi up with gains of around 0.5% in trade, Hang Seng 2 trading with gains of more than 1.5%, nearing the 2% mark as well as what we're seeing coming in terms of Shanghai, also almost 1% of gains there. Japan's Nikkei is also trading with gains of around 1%, while ASX 200, that's Australian index, is also trading with gains of 1%. So we do have a positive handover coming in from US. Plus, you know, we've seen that Asian stocks are rallying in trade as well. That positive commentary that we've seen coming in from a Fed, where he's signaling smaller hikes, is something that is keeping even the Asian markets on the positive footing. Now, even when you look at the SGX Nifty as of now, it's up 0.3% in trade, so a bit of a muted to a positive start, we could say, coming in. Not as clear indication of a positive start, more like a muted indication for the SGX Nifty, and is what it's indicating. And expectations for the Nifty is a muted start. Now, in terms of commodities market, let's look at what we've seen coming in Brent crude oil prices. Actually, they did rally as much as 3% overnight, but as of now, when you see them opening in trade, as of now, seems like a subdued trade, more like an unchanged move coming in. Whether you look at the Brent crude oil prices settling around the $85 per barrel mark, about that mark as of now. WTI crude oil is back above the $80 per barrel mark as well. So we had seen a sharp jump coming in overnight in the crude oil prices, because what had happened after the US Energy Information Administration, or the EIA as we know it, reported that the drawdown of 12.58 million barrels for the week ended November 2025, November 25th, I beg your pardon. So that is a factor that is coming into play for the oil prices. While in terms of gold prices, they've seen a jump of almost 1%, coming in trading almost at a 3-month high as of now, over a 3-month high actually, and trading above the $1,790 per ounce mark. So that is a factor coming into play for gold prices, and that's the update coming in on commodities front as well.
Right. Thank you for that handover, Vinny. Now, moving on, the insurance companies are unlikely to meet the IRDAI deadline of dematerialization of insurance policies. Now, IRDAI has given a target of December 2022 for the new policies and December 2023 for the old policies. Now, my colleague Anurag Shah has more details on it.
Dematerialization of insurance policy, which is a very big step in insurance sector, in which all insurance policies will be in electronic forms only. Recently, insurance regulator IRDA has asked insurance companies to issue all new policies in a demat form from December 2022, and to convert all old policies, all existing policies in a demat form by December 2023. But as per our sources, insurance companies has asked IRDA to give them more time to comply with this, because according to insurance company, this is a very mammoth task, and they need to link their system with repository, and that will take some time. LIC has asked IRDA to give them 2 to 3 years to dematerialize all their old policies, because LIC has 25 crore insurance policies, and which will require time to convert all 25 crore insurance policies into a demat form. So as per our sources, as insurance regulator is also working on a new e-marketplace, insurance e-marketplace, Bima Sugam. So with the launch of Bima Sugam only, it will be mandatory for insurance companies to dematerialize their insurance policies. And once the Bima Sugam is in action, all new policies which will be issued will automatically in a demat form, because they will be linked with a repository.
And shifting gears, let's talk about the auto sector. Yes, it's first of the month. You have the auto sales numbers coming in. And this time around, in terms of the November sales numbers, it's expected to be a bit of a muted number coming in terms of the sales. Let's go across to Shrishti, who is going to give us a breakdown on what should we be expecting from which company in terms of numbers.
Well, for the month of November, we are expecting the wholesales growth to remain relatively lower on the back of the destocking after the festive season, and across the segments, we are expecting a red number, that is a decline. Firstly, let's start with the passenger vehicle segment. So here we know that the demand remains unaffected for the premium segments. The waiting period is quite very high for some of the top selling models. But when it comes to the lower end vehicles, the demand was quite muted. For Tata Motors, Maruti and for M&M Automotive Division, we are expecting a decline in single digits between the range of 4 to 6%. When it comes to the two-wheeler market, there we get to understand that the retail demand for two-wheelers was quite reasonable. The urban demand was seen to be leading despite the rural recovery, and in not just that, the scooters did perform very well in comparison to the motorcycles. And coming to the export numbers, so for Bajaj Auto, we are expecting the exports to be flat on a month-on-month basis, while for TVS, a recovery and an uptick of 5% in the overseas market is what we are expecting. But when it comes to the Hero MotoCorp sales data, then there we are expecting a decline of 17% on a month-on-month basis, while for Bajaj Auto that is 13%. And when it comes to the Royal Enfield, there too we are expecting a bit of a decline, but the Hunter demand is quite very strong as of now. Coming to the commercial vehicle segment, what we get to understand is that it was a kind of a flattish month-on-month sales, where the supply chain issues in the LCV portfolio is quite largely behind, but the rising interest rates is something that is hampering the growth. So a decline in overall numbers on a month-on-month basis is what we are expecting. And lastly, if we look at the sales data in the tractor division, there we are seeing the momentum after a normal festive season, but on a month-on-month basis, a cut and a decline is what we are expecting. But overall, it was a decent sales month for tractor division as well.
Right. Thank you for those details, Shrishti. So largely flattish sales for the November month for the auto sector. But now we have Ashesha in the studio. Ashesha, so what are the stocks that we will need to watch out for in trade today?
Hi, good morning, Vinny as well. So Zomato will be the first one in focus in today's trading session, and that is because Alibaba sold about 3% stake yesterday, and currently Alibaba's stake stands at about 10%. Additionally, Temasek, which is Singapore state government firm, has picked up 1.1% stake in Zomato for about 608 crore rupees yesterday. The company bought these shares via investment vehicle Camus Investments at about 62 rupees per share, and post this deal that took place yesterday, its share will stand at about 4% stake in the company. MOIL will also be in focus, and that is because of price changes that have come in with effect from the 1st of December. They've gone ahead and informed the exchanges that prices of all ferro grades of manganese ore, fines and chemical grades have been reduced by 5% with effect from the 1st of December versus the month of November. Base price of EMD have also been increased from 1,80,000 PMT to 1,85,000 PMT. Moving on to real estate stocks, then Oberoi Realty, Godrej Properties and Suntec Realty will be in focus, and that is because registration of properties in Mumbai has risen by 15% to 8,756 units in the month of November. Registrations rose on higher demand despite increase in interest rates that we are witnessing. Highest demand was seen in the properties in the range of 1 to 2.5 crore rupees per unit. Paytm will also be in focus, and that is because they will be holding their first ever physical analyst meet today. Moving on to East My Trip Planners, then board meet to consider acquisition will be held today. Shilpa Medicare will also be in focus, and that is because they have informed the exchanges that they have finished the finished dosage form manufacturing facility in Telangana has received Health Canada GMP approval. This also means that the company will or can do commercial distribution of products in Canada and will enable new application submissions to Health Canada. And lastly, Cosmo Health will be in focus, and that is because board meet to consider buyback of equity shares is scheduled to happen today.
Okay, Ashesha, thank you so much for that update on the stocks to watch out for in trade. But let's go across to Vamakshi, standing by to tell us what the brokerages are saying this morning. Good morning, Vamakshi.
Well, good morning, Winnie. Let's first start off with the gas sector. It was in focus yesterday and will continue to be in focus today after Morgan Stanley has come out with a report which says that the gas price liberalization proposals would be significantly positive for the upstream producers. This in turn will pave way for growth in production and demand for gas, and they believe that this will lead to full freedom in marketing of gas by almost 2027. Now, apart from that, they also expect the street estimates to rise for ONGC, Oil India and Reliance, and they see nearly 10 to 12% potential upside in the earnings. So on the back of that, they appear quite positive on the gas sector. We have Reliance in focus as well. We have a note that is coming from Jefferies. They've maintained a buy on the stock, also given a target price of 3,100, which is a significant upside from the current levels. They also believe that the diesel export duty could go with energy price correction, which is very positive for RIL. And why is that so? Because RIL's FY24 EBITDA will receive a 5% or $1 billion boost if the duties are withdrawn. So overall, Jefferies is looking quite positive on Reliance Industries. And Tata Motors is the next one on our radar. Goldman Sachs has maintained a neutral rating on the stock. They met the senior management of the company, and here are some key takeaways from that meet. MLA5, EMA and Jaguar BEV platforms are on track for launch in the next 2 to 5 years. Financials are looking at higher residual value potential of half-life EV batteries versus IC engines. They're also expecting 10 EVs in India by 2025 to 2026, and the India CV business is likely to reach double-digit EBITDA before the India PV business, is what the management had to say. So on the back of that, Tata Motors, Goldman Sachs has maintained a neutral rating.
Right. Thank you so much, Vamakshi, for joining in. Do watch out for the stocks in trade today. Moving on, Oil Ministry has asked for protection of LPG customers from rising gas prices. Now, ET Now has learned from sources that the ministry has asked for 7,000 to 8,000 crores and recommended the continuation of subsidy to Ujjwala customers. Prakash Priyadarshi has more details on this.
Yes, we have been informed by our sources that the Oil Ministry may get rupees 7,000 to 8,000 crore from General Budget 2024. Sources are informing that the Oil Ministry raised this demand during pre-budget meeting with the Finance Ministry. Oil Ministry is in favor of protecting consumers from high LPG prices. Subsequently, it wants Finance Ministry to continue providing rupees 200 subsidy on every cylinder to 9 crore Ujjwala customers. As per the government data, around 90 lakhs customers didn't even take single refill in the financial year 2022 due to high LPG prices. Subsidy amount may help consumers to increase refill rate, which is 3 to 4 in a year. Also, high refill rate may help oil marketing companies to recover their dues on consumers. OMCs have around 4,500 crore dues on consumers under Ujjwala scheme, especially because of low refill rate.
Okay. Let's move on to another ETNOM exclusive that we have. The government is likely to look at removing windfall gain tax completely, and they could do so if global crude prices come down to $75 per barrel mark. Now, so what is the government actually thinking, given that there has been quite a bit of a volatility when it comes to the global crude oil prices? Let's go across to Meghna Mittal, who's joining in with us with some exclusive details on this front. Meghna?
Right, so as we know that the windfall gains tax was implemented on the 1st of July earlier this year by the government to absorb the super profits that the companies were making, because the global crude oil prices were much above the $100 per barrel mark. With now the crude oil prices trading much lower, what the sources in the government are confirming to us that they are of the view that once the crude oil prices they touch the $70 to $75 per barrel mark, the government may be looking at removal of the windfall gains tax completely, because the sources in the government, they are of the view that once the crude oil prices they come down to the level of $75 per barrel mark, there may not be a case, because the companies may not be making those super profits, so there will not be a case of continuing with this windfall gains tax. Meanwhile, the government is also closely monitoring what the decision is of the OPEC regarding the production cut, because that also will have a huge impact on the crude oil prices. But remember, because the crude oil prices are already trading very low, the special additional excise duty, that is the windfall gains tax on the export of petrol, that's what is implemented, it was removed much earlier on the ATF, and the diesel is still continuing, but that also has come down from the levels that it was implemented. On the cess production also, we have seen that from the levels of rupees 23,500 crore per ton that was implemented, that also has come down by more than half. So now it remains to be seen that when the global crude oil prices touch the $75 per barrel mark, so that the government can look at completely removing the windfall gains tax.
Right, and moving on from oil to gas. Now, gas stocks were buzzing after the pricing panel's recommendations. Chair of the panel, Kirit Parekh, told ET Now that they have recommended a floor price of $4 per MMBTU. Now, they will market link the prices from January 2027. Here's a slice of that chat.
First thing, if you say, the main recommendation concerned the APM gas pricing. The APM gas has the administrated price mechanism, gas which is produced by ONGC and OIL from fields that was allocated years ago on a nomination basis to them. The government owes 55 to 60% of the stocks of this, is the owner of these companies. So what we have suggested is that you should have a floor price of $4 per million BTU, and that is required because that price would cover the marginal cost of production of these companies, public sector companies. At the same time, we said there should be an upper ceiling on it of $6.50, such that this will also cover protect the consuming firms like city gas distribution companies and fertilizer, etc., from the currently very high prices in the international market and very large volatility because of the Ukraine conflict and so on. So we have suggested an upper ceiling of $6.50, And we have suggested that every year it should be raised by $0.50. And by 2027, 1st January, these prices should be completely free, APM. And the ceiling and the floor prices should be removed.
Okay. And let's move on. Earnings growth estimate of 20% still has a scope for upside, says Rhythm Desai of Morgan Stanley. He believes a major capex push will aid this growth and remains bullish on financials as well as the discretionary space. Let's go across and listen in.
Next year, earnings I think will still go up. The PE may fall a little less, and therefore the absolute return may actually be a little better. So the context is of the world. So just to put it into context here, my US strategist thinks the SPX finishes next year at 3,900, which is an absolute downside from here, okay, still. And he's been very cautious all through the last 12 months, and he's been right, and he remains relatively cautious. He does think that the bear case scenario may take the SPX down materially from here, but in his base case scenario, SPX is trading flat. My emerging market strategist thinks markets like Korea and Taiwan could be up 20%. So India fits somewhere in the middle of 0 and 20. It's unlikely due to 20 because Korea and Taiwan trade at near one-time book. Okay, they're so beaten down that a little bit of earnings recovery and the multiple will rise. In India, I think we're still in this multiple consolidation phase. There's a bull case scenario in which that changes, but in the base case, I think we're still in that phase.
The most powerful number for me in this report, I'm just speaking for the benefit of our viewers, the way Rhythm looks at is that he absolutely looks at earnings growth. You are making a case for a 20% CAGR earnings growth on a large base for next 3 years. Now that's a very powerful endorsement on earnings because ultimately what you can predict is earnings. P multiple, market price, flows, technical, those all are derivatives. I'm breaking it for the benefit of our viewers. So let's try and understand that what gives you the conviction of this kind of a strong earnings growth, because within 20% plus, which means 3.5 years you expect earnings to double from here.
Yeah. The main anchor to earnings is capex. If you can get capex going, you get earnings going. Until that capex becomes unproductive. And then, of course, the economy slows down and you go into a slow growth or recession. But we are really far away. Look at corporate balance sheets, heavily depleted in terms of capital stock. No investments in the last 12 years. Look at corporate leverage, debt to GDP. Corporate debt to GDP is 46%.
It's less than 50. It's not 6 actually.
Yeah, down from 62. Private sector credit to GDP is 57%. China is at 225. US is at 200 plus. Bulk of Europe is at 200. India is under-levered. So you have balance sheet strength and you have a growth cycle that's recovering. It's an ideal combination for a credit boom. And a credit boom essentially means higher growth. So this is a very sweet environment. The key risk is what the world does around us. The second half of next year will probably be trading around elections rather than earnings.
Okay. So since you've already preempted my question, I won't go on that path, that what will happen exactly a year from now when markets will get into the election zone, so to speak. But your case of a 20% earnings growth, let's divide that into two parts. There are some sectors which will have to grow at 25% plus, 30% plus, and some sectors will grow at 20%, below 20%, and the mean could be 20% plus. Draw that line for us.
That's very easy. All external facing sectors will probably underperform. So global materials, energy, and to some extent even software services. They'll underperform in terms of earnings. May not underperform in terms of share prices, we'll come to that, but I'm just addressing earnings. All domestic facing sectors which are cyclically oriented, like discretionary consumption, industrials, and financials will outperform. In addition, I think some defensive domestic sectors will also underperform, like utilities, consumer staples, telecoms, will underperform, healthcare. So I think that's how you look at it. Global sectors and domestic defensive sectors will grow less than 20, and financials, consumer discretionary, industrials, your quintessential, cyclical, rate-sensitive sectors will grow more than 20.
Right, and that was Rhythm Desai for you. Moving on, Max Healthcare Institute is believed to be eyeing the Kolkata-based Imami Group's AMRI hospitals with a counter offer that trumps an earlier Manipal Health Enterprises bid for 900 crore rupees, triggering a potential full-blown corporate war between the two of the country's leading hospital chains. Now, Max has made a counter offer of 2,700 crores to buy the AMRI chain to strengthen its position in the East. AMRI has 3 super specialty hospitals in Kolkata and another one in Bhubaneswar. Now, the chain has a capacity of 1,200 beds across its hospitals.
Okay, with that, we're absolutely out of time with this edition of Market Cafe. SGX Nifty indicating a positive start coming in for the Indian markets. Don't go anywhere. The markets will take the action forward.